Welcome back, Keith. Today we've got Keith Hobart from Peak Mortgage joining us to talk about mortgage interest rate trends and discuss between fixed and adjustable rate mortgages.
Yeah, Joe, how are we doing?
Good. Welcome back.
Yeah, thank you. Thanks for having me.
Yeah, so let's dive right in. Got a lot of questions, especially lately with rates being not high, but as high as they've been in a while.
Yeah.
People are asking about adjustable rate mortgages. So this is a good opportunity to talk about that and upsides and downsides and get some professional advice on what somebody should consider.
Yep, totally.
So let's just dive right into some questions. First thing is everyone's favorite question. What are the interest rate trends and how do they compare to the past?
Yeah.
What are we expecting?
And what are they going to do?
Yeah. The question that everyone wants to know and no one has an answer to.
Yeah, I wish I could definitely answer the latter. Yeah, I mean, the last couple of years, we've definitely been in a higher rate environment. And like you said earlier, I mean, it's all relative, right? I mean, if you go back far enough, these rates aren't really high. But if you want to just take a nice little picture of the last 10, 15 years, they're definitely not on the higher side of things. In terms of kind of where they've been, we've kind of just been riding kind of this channel. I mean, there's a short time we dipped in the low fives, but for the most part, we've been in call it the mid sixes all the way up to the mid sevens.
Yeah.
So we've kind of been riding that channel the last couple of years. A lot of experts out there think we're going to be in that for another couple more years. You're going to have little dips or peaks and valleys through that over the course of a year time.
Right.
But yeah, we're not. They're not going to be going down to 2 or 3 anytime soon. So yeah, that's kind of where we've been riding. And so because of that, we've had to get creative with financing and figure out ways to appeal to those higher rates and how do we help combat any objections we might have on that. So
yeah, I think something kind of big picture that is important to look at is that 2 and 3% rates usually mean there's some
catastrophic.
Yeah. The economy's not doing well. Last time it was COVID, all that. So if rates holding steady is actually a good sign overall. It just isn't great for
to get down to 2 you would need probably a World War III. None of us want that. So
yes. And I guess kind of go over the differences between fixed rate and like a 30-year conventional or an ARM. I think there's just because they haven't been so popular in so long, I think maybe there's some misconceptions and some people, like I said, I've had a few people ask lately, why wouldn't we do that? And so I think it's important to kind of talk about, especially right now, at least my understanding is it's not super advantageous, but love to hear what your thoughts are.
Yeah, exactly. Yeah. So, I mean, ARMs are just that. It's adjustable rate mortgage. It's fixed for a certain period of time, generally 3, 5, or 7 years. Those are the primary, most common ones. And then they kind of adjust based off of what the current rates are at that time. So they can be a good product. I mean, a lot of the people that I talk to about that is like, hey, if you absolutely know you're going to be moving in a few years, and we can get you a better rate by going with an ARM, then why not? There's a lot of people out there that are unsure of how long they're going to stay in the house, or they always say, hey, I'm going to be in this house forever, right? How many times have we heard that? And then 2
years later,
yep, they're married with 2 kids or whatever it may be, but all of a sudden a couple life events happen, they got to sell. So,
yep.
So there's pros and cons to each one, but adjustable rate is exactly just that. It's a loan product that the rate will adjust depending on market conditions.
Typically, or in the past, my first time I bought with an ARM, the advantage was that at least the initial rate was a little bit lower. It saved me quite a bit, and knowing that in that case, I was probably going to be refinancing or moving within, I think I had a 7-year ARM. Is it worth it? Or what are rates like for ARMs compared to the fixed?
Yeah, generally, to select an ARM product, you're going to get a lower rate initially, right? Right now, we're not necessarily seeing that. We're seeing the ARM products be very, very in line with the fixed rate products. And because of that, we're not doing a whole lot of adjustable rate mortgages. There's been a couple jumbo products during the right time. I was able to get those locked on an ARM, and it made sense but for the most part, most of your conforming products are very similar to fixed rates right now. And that basically just has to come with investor appetite. The investors don't have an appetite. They don't necessarily want to sell a ton of those ARMs right now. So they're pricing them very competitively they're pricing them very in line with fixed mortgages and just going to go that route. So
it sounds like something that people really, if they're interested in it or thinking about it, they really need to dive in and see if there's actually even savings.
Exactly. Yep. Exactly right.
I guess maybe my viewpoint on it, and again, I'd love your input. If they're the same rates, there's not really any advantage.
Why risk it? Yeah, why risk it?
So at some point, that rate's probably going to or could go up.
Yep.
And you might as well take the 30-year or whatever long-term set rate.
Yep, exactly right.
And then, yeah, I guess, we kind of talked about how they worked and how they're kind of fixed for a period of time. What happens after that period of time? How do they go up? How is it determined? Is it, is there like, can they go up 10%? Is, what are the risks there just as far as what happens after that, sort of fixed period comes to an end?
Yeah, great question. Every ARM product's different. So we'll just kind of talk just the most common ones. So again, you're looking 3, 5, 7-year ARMs. So that just means that the initial rate can adjust on year 3, year 5, or year 7. Sometimes they can only adjust every year. Other times they can adjust every 6 months. There's a couple different options out there like that. And then, yeah, that is capped. So if you have an adjustable rate mortgage that's at 6% for the initial thing, it can't jump up to 20%. It is capped per year in terms of how much it can move up. And it's also capped over the lifetime of the loan. So it can't jump up 10 percentage points and just keep going up and up and up. So
are those caps per loan, or is there like a government like overall fixed, or would that just depend on
it just depends on the loan product? Yep, exactly right. It's per all loan. It's per loan. That's how it's driven. It is tied to essentially the Fed rate that they set for interest rates, and that's determined if rates are moving up or down, and if your ARM's going to adjust up or down. So
is that like a prime plus kind of?
Exactly, yeah. And that's on the flip side too, right? If you select an ARM and we see rates go down in the next few years, and then all of a sudden your rates adjusting down, that's a pretty nice surprise.
Right.
But when we're initially talking with everybody, it's like, hey, we're setting the expectation of, hey, expect this rate to go up. If it stays the same or it goes down, then great.
Congratulations. Yeah.
Yep.
And if you don't have that, if you don't have it and they go down, if you have a fixed term, you just refi.
Exactly. Yeah, exactly right.
And then good question here. I guess what factors influence the rates and how often do they change? I mean, you talk about 6 months on an ARM. More broadly, I guess, how often do rates in general just
this is actually a kind of a surprising question that not a lot of people obviously pay attention to, right? But I tell everybody, hey, it's similar to the stock market. I mean, our interest rates are moving up and down every day. Historically, we don't have huge swings, right? So in a normal market, normal time, you see rates just moving up and down just very little. In the last few years, we've seen a ton of volatility. And because of that, we've seen rates jump a full 0.5% in one day. And we've seen a lot of quarter point adjustments in one day. And then you look at over the course of a week, and we've seen move 0.5% over the course of a week. So you're seeing these huge swings that we're not normally accustomed to seeing. And so it can make things really hard, especially if I quote a customer one rate today, and all of a sudden the rates jump up 0.5% in 2 weeks, and they just went under contract in that 2 week period. And now all of a sudden I'm quoting them a mortgage payment that's a lot higher. It's not necessarily the most fun part of my job, but there's just these things are all outside of everyone's control, and it's just it's an interesting time in the market right now.
Yeah, and on that note, like say you get in contract, there's the your rate lock. Do you at what point do you lock that rate, and do you give advice on, hey, we should wait a day, we shouldn't, or is that I don't know if that's too far to try to predict, and then or what, but yeah, how does that work, I guess, with the rate lock and when to lock?
So typically we lock once we have an address. So once you go under contract, then we can lock. There is some niche products out there that we can explore later, but for the most part, you're locking once you get an address. And generally, the last couple of years have been really hard to kind of game the system, right? It seems like kind of everything's backwards. And when the rates are supposed to go up, they go up. And when rates are supposed to go down, they go up. I try not to get too cute on that stuff. And I let most of my customers know when it comes time to lock in, it's like, hey, there's more risk to the downside here than there is the upside. Maybe if we roll the dice, maybe we get an 1/8% back, but we could lose a quarter overnight. So a lot of times I'm just suggesting customers to lock as soon as we can. So
that makes sense. And then shifting a little bit just into the fixed rate, there are a couple options there. We've got a 15-year, 30-year. I know there's also other in between ones, 20. I've heard of 25. What are your thoughts on those as far as talking to clients about them? How do rates compare between them? What are advantages or disadvantages?
Yeah, the 15-year and the 30-year are the two primary ones, right? We do have some investors out there that I can lock actually from any time frame from 10 to 30 years. So if I was refinancing you and you didn't want to reset the clock, I could actually refinance you into a 27-year mortgage if that's what you had. So that's one really cool product that we have. For the most part, you're doing 15, 30 years. What I let everybody know is like, hey, the rate's going to be generally a little bit lower on a 15-year mortgage. I mean, roughly about 0.5% lower is historically kind of what we see, but you're going to be married to that 15-year payment. So it is substantially higher. I mean, as you can imagine, you're paying it off in 15 years as opposed to 30. So substantially higher. The interest rate savings is crazy though. I mean, you save a ton of money on interest, but again, you are married to that 15-year payment. So something catastrophic happens if you dual income and maybe one person loses their income or just whatever it may be, you still got to make that 15-year mortgage payment. I always want everybody to be very aware of that before they jump in that. I could tell them, hey, if you want to take this 30-year mortgage down to a 15-year, but actually keep the minimum payment at 30, just put this much more per month towards the principal, and then we'll turn this into your own 15-year mortgage.
Yeah, that makes sense. And then that way, if there is a hardship or whatever, they're not committed to the higher 15-year payment.
Yep.
That makes sense. Yeah, I think those are great questions. Honestly, that's probably a list of some of the most common questions I've been getting lately.
Great. Yeah. No, they're all great questions.
Appreciate it. Well, thank you for joining me. We'll look forward to having you back.
Awesome. Thanks, Joe.